Hello guys, I'm Jalaj from Stock Trading. Today, like in the recent time, we have seen coronavirus has affected like lot of areas in our country and also outside in the as a global economy. So today, I thought of like making a video on how to select good mutual fund and especially focusing on how to select equity fund as like most of the investors still invest a good chunk of their money through mutual funds. So it is very prudent that we should know that anyone should know how to invest, how to find good mutual funds. So first, like let me start with the basics. So as like we already know, this is my website. Like I will post this link in the description. And first, like we know, we have lot of mutual funds. So generally, like two or three types of mutual funds are there. The one is like equity mutual funds, which are directly linked with the stock market. Other are debt mutual funds, which are generally considered safe and give a fixed yield, which is known as like interest rate per on monthly and or annual basis. And other like are also kind of different, which are known as hybrid mutual funds, which are some like in between of these two categories. We so these can be combination of equity or debt funds. So I'll not go much on the what are different more varieties of mutual funds. I'll come straight to how to evaluate equity mutual funds. So let's start with the basics. For the equity mutual funds, for any mutual fund, we have something like NAV, which is not known as net asset value. So for evaluating mutual funds, I'll be using like two websites. The first one is this hdfsec.com, which is HDFC Securities website. Another one is like Value Research online. So these two websites are already very authentic, and the data published on these two websites is considered of like high value. They like this can be trusted with blind eyes. So for like for example, like I'll take a so I'll open any mutual fund to see, like for example, ICICI Prudential, like blue chip regular fund, and I can open. So as like we most of like people will be already knowing that we have generally two variants of the mutual fund. One is known as like regular mutual fund, and other one is direct. The regular is generally like having a higher expense ratio as compared to direct one. So here like we have two types of which we can select. So for the regular mutual fund, like we can easily see like what is the minimum load. So we can just find the load here to see like this is known as the expense ratio. For this the regular fund, the expense ratio is around 1.73, and for the same fund if we go for a direct plan, so the expense ratio will be less than 1%. So see, like expense ratio is like around, the page is still loading here. So the expense ratio is 1.17, so which is considerably low, uh, below than the regular. So this is like most important. Like we should always go for a direct plan whenever it is like we have a choice of going for a direct plan. The second thing, which is the most important while evaluating a mutual fund, is that the AUM of the mutual fund. So we generally have the AUM is the net asset. Net asset is like the how much money the mutual fund is having. So, so for this ICICI Prudential Blue Chip Fund, the fund has invested around 24,000 crore in the market. So this is the money which like investor has pumped into this scheme of this mutual fund. Okay. So after that, like most of we already knowing that returns, how to check the returns and all those things. Other thing too important which I want to like highlight, as we change the certain schemes, the returns the returns and the benchmark changes accordingly. So for like this fund, the ICICI Blue Chip Fund, this is actually a blue chip fund. So it's like mostly invested in the large cap. So here we have also it is written, it is like investing in the large cap. It's a large cap fund. So it is generally like less volatile compared to others. So I will just tell you how to check the volatility of a fund. So here just I want to tell you that like for the fund here the returns are mentioned, and against this like S&P BSC 100 TRI is mentioned. So this is the benchmark against which the fund will be evaluated. So the fund manager, whenever it will quote that like and they have outperformed the index or outperformed the market or something like that, so they will always quote it from this in from this benchmark. So this is the benchmark which they have chosen. So they will be comparing themselves for from this benchmark. Okay, and after this like we can know about this fund, how this fund is performing within the category. So we have like category, generally we should not go for below 6 months or below 1 year of the performance, and we should always see it for the larger holistic view for the fund if it is available. So for this fund like out of 60 funds in this category. So the category was this equity large cap. The category was equity large cap. So out of equity large cap, around 60 funds are there, and out of that, the fund is performing at 43 level for a 1 year given time frame. And for the other one, like the fund, 51 funds are there for a 3 year time frame. It is on 36 number. So the number actually changed. Why? Because number this 651 because lot of funds were started in recent times. In last 2 years, lot of mutual fund companies have started their new mutual funds. So that's why the like older mutual funds are not reflecting in the 5 years. So it is getting reduced and reduced. For 7 year, only 48 mutual funds, only 48 schemes were there by different mutual funds. So for a 7 year period, this mutual fund actually stands at 11th number, which is considerably good, if not like turnover, if not bad. So the next thing which like I like to focus is the how to evaluate like the mutual fund very closely. The second thing, like as I already told, the mutual fund is having the expense ratio, and we should always go for the expense ratio. So one person should know that like whenever like we are checking these returns, whatever returns are quoting here, like these returns are not the final returns which an investor will get. These returns like investor will get only after subtraction of this expense ratio. So say like the fund has performed 4.19. Okay, so we should subtract this 4.1, just a second, 4.19 minus 1.17. So this is the final return which an investor will be getting. Investor will not be getting 4.19. Investor will be getting 3.002. So this actually need to be checked by investor whenever he or she is investing in a fund. So like most of the funds are having higher expense ratio. So for those funds, the overall return will be reduced. Okay, and the exit load is already applicable. Like the exit load is the load is the fees which actually fund charges if you withdraw from like before a given certain time period. Okay, and the other thing which like I like to come upon the is the AUM. As like I already told, like we AUM is the amount the fund has invested. So we should not consider like the consider those mutual funds which are having AUM less than 1,000 crores. So so why the reason is that like those mutual funds are very new and like generally having less exposure. So less exposure in the companies which they are investing. So like I like to say that those mutual schemes mostly like those schemes have recently been started, and like the fund manager might be having less fund to deploy in the market. So whenever like we are going for the uh, for any scheme, you try to select a scheme of having higher assets, so that like fund manager is having sufficient amount of capital to deploy in the given in his or her selected stocks. So like I'd like to come upon the second thing which is most important is the beta. So here is the things which a person should see. So see, this column is heavy is most important. Like, this column is most important for it's like the most of the investors generally ignore this column, but this is most important crux of evaluating a mutual fund scheme. Okay, so like first of all, I like to come upon on the beta. So this beta is like it is a value like how volatile your fund is against your this S&P TRI. Okay, so if your fund is having higher beta, so that means like if it is very highly volatile. So if market moves 1%, the fund moves like here in this case your fund moves by lesser percentage. So your fund is considerably less risky. So the like beta is actually known. It's also used to check the risk and reward trade-off. So if you want to invest in highly, if you want to get higher returns, and and at the same time your riskiness also will increase. So if you're investing in, so say in a fund for having beta like greater than 1.1, greater than 1, so like that fund might be will definitely be more risky. At the same time your fund can deliver more return. Okay, the other thing which is important is the standard deviation. The standard deviation is the like how much your fund will be volatile. So say like here standard deviation is like 11. So this is a number like how much your fund will be volatile. So it is bit mathematical, but for a general say like in the higher the standard deviation, higher the will be the volatility of your fund. So it is something like beta, but it's not very much similar. So this if your fund is having higher beta, so that means that the fund is more risky and like is more volatile. And the other thing is like low known as alpha. Alpha is that like is the uh, is the amount by which your fund has outperformed the benchmark. So say like benchmark is this 100 TRI, so your fund has outperformed by 0.19%. That's all. So it is like less than 1%. The other thing which is also considered very important is the sharp ratio. So we have the sharp ratio and sorting ratio. So actually sharp ratio they gives the amount of the risk which the fund manager is taking against like amount of trade-off he is providing. So say upon like if I am taking risk of 1 rupee, so then I am delivering a reward of 0.56. Okay, so by taking a risk of 1 rupee, I am getting a reward of 0.56. So see, and the other thing which is important like is this sorting ratio. Sorting ratio is also considered very important. So say like if a fund like is is like too much volatile, and too much volatile means more like the fund is having a more downside possibility. So see, so like in the recent time a lot of funds have invested in the PSU stocks. The PSU stocks are like are becoming garbage, like at the PNB, IOCL and IOC, all the stocks are like going garbage, and most of the stocks are trading at lowest 52-week low. So such stocks are clearly to be avoided. And these the funds which have invested in these kind of PSU stocks will have very low sorting ratio, very low. So for the calculation, like for I have also taken here example. So say upon like the fund is having annual return of 15% and a downside deviation. Downside deviation is the capability which a fund will be having on the downside. So you can lose about, so here in the example you can lose around 13% of your total capital. So in this scheme, in the scheme B, your annual return is 10% and downside deviation. So for example, if you pull the money at any time, you can lose 4%. So here, if you calculate the Sortino ratio, of two funds, which is like annual return divided by downside deviation. So in the first case, sorting ratio will be 0.69, and in second case it will be 1. But if you will check the annual returns of the scheme 1 is greater than, far greater than annual return, which is like 50% greater than that. But still, like fund B is considerably more safe and more giving more reward to your investor, as compared to downside deviation, downside risk which he or she is taking. So this thing is also very important. So a general investor should see for the higher Sharpe ratio, higher Sortino ratio, lower beta, higher alpha. Okay, and that mean we can generally avoid. Okay, and these are the rank within the category which we for which like we are. It should be like considerably greater, but we should do due diligence because beside all those things also. And other important thing which we should see is the how much the capital which a fund has deployed. So see, this is a like example of equity mutual fund, and in the equity mutual fund, like most the fund generally invests in mostly equity, like it will depending upon the scheme type, it will be allocating the fund within the different stocks and uh, um, stock and debt. So here it is like a large cap fund. If large equity fund, it will be mostly deploying its fund in the large cap stocks, and rest it can or cannot. It can, depending upon the fund manager's choice, it can define that it can deploy the money in the debt part or in the cash part. So say here in this example, the fund manager has deployed around 5.9% of the total AUM. Total AUM is deployed in this allocate in this uh, debt part. So this, so considering the like present scenario, if like a fund which is having a higher exposure of high asset allocation towards equity can be more volatile. But at the same time, if an investor who wants to take more risk, so he or she should go for a higher equity area. So the fund should be like fully invested or like will having negligible allocation towards the debt part or the cash part. Okay, and the other thing, the uh, which a investor can see is on this website, SDFC Sec. It's a SDFC security website where one can search for the mutual fund. So see where you search for ICSI mutual. I guess there's some internet issue. So we'll take this example only. So ICICI Prudential Nifty. This is also a mutual fund. Okay. It got opened. Mm, okay, it's not getting open. Okay, yeah, it's there. Okay, so this is the fund which I have opened. We can see the the return, 3 year return, 5 year return, and all those things at the same time. This is like very good website. It shows everything at the same time. Okay, and the thing which I want to show is the AUM part. So here we can see how the fund AUM is growing. So see, like this is not very important parameter, but still, like if a investor can just see the fund AUM performance. So fund AUM performance will give him or her a good idea that like how much the confidence the investors are having again in the same mutual fund scheme. So see here we can see like the AUM was around 9,000 crore in the January 2016, and then it's consistently growing, and now it's quoting around 25,000 crore. The fund is just 3 times in just like last 4 years, yeah, like 3.5 to 4 years. 4 years. So if the AUM is considerably growing, the fund is considerably. considered good, but it's not a very important critical parameter. But it can, like, in person can, investor can just check for this also. The other thing which is like not can be selected depending of, because it requires a certain due diligence and knowledge of the markets, how the various companies are like distributed, and where one should park his or her money. It is the last parameter, but it's also very important. But for an investor, there is a concern that he cannot select this parameter very easily, which is known as like top holdings. This is the holding like which your fund has invested in. Generally, like, most of the investors are new and they don't know about the market, so they can just select for the large cap fund, or the like fund which is having higher ratios and all those things, higher AUM or etc. But still, like, the top holding part, the where like fund has invested is very important, like how your fund will be delivering performance in the future. So if you are having good idea, then only like you should go for like checking for the top holding, because this will determine the performance of your coming returns. So say, like, if you will see for this fund, so this fund is having like major component, as it is a blue chip fund, is having major component in the large cap, like be among most top companies of like which are part of Nifty 50. So say like HDFC Bank, ICICI Bank, Infosys, etc. So it's having like another part, like good exposure in the telecom. So like Nifty is having good telecom, so this fund is also having telecom. So for an investor like who is having good knowledge, so he should know that telecom has not performed in last 5 to 8 years. Telecom sector has like given very poor returns, and like Bharti Airtel is just like at a break even in the last 6 years, which is might give a breakout soon. But still, like, this fund is having, and this company is having a lot of issues because of like the debt load, and borrow large kind of borrowings heavy. So this sector has not performed. So like the investor who want to skip the telecom sector, he can like select the other blue chip fund which is not having exposure. But this all depend upon the investor's type and his knowledge, whether he or she want to get invested. And like no one can predict actually in what return can what return the fund or the company will be delivering. We can all just justify and make the good due diligence, so that like we can select a good fund. So see, like, the other thing here I see here, the fund is investing in Reliance Industries and the SBI Life Insurance and ITC. These all like Reliance is outperforming the market for considerably 2 3 years, and we can assume that it can outperform because like Reliance will be unlocking the Geo from its Reliance Industries, which will help more further increase in the stock price of the Reliance Industries. So this is also very good area and good company to get invested in. And the other is the underpenetrated sector like SBI Life Insurance, which is also very good, and we already only having three companies, 2 or 3 companies listed in this sector. And as like current scenario, most of the uh, Indians are not having so much insurances, so this sector is like underpenetrated, and according to me, like this sector will grow more in future. Definitely, this is a good buy uh, at present time, and might give you good return in the future. So say like, and the other thing one can see, like in the automobile sector, the fund has a considerable amount, say like Madan Susumi and Maruti Suzuki and other like TVS Motors. All those things, these are the risky bets. So if you think like the fund this risky bets fund can outperform in the future, so you can take considerable risk here considering this fund. But still like it's all depend upon upon your due diligence, like how you think and how you can comprehend this data. According to me, like this automobile sector is the like be a good amount of contributor in the tax revenue system of India. And definitely, like if India will grow more than uh, more than like 7-8%, which is expected to be growing, then definitely like autos without auto sector it cannot grow at that pace. And definitely like auto sector is will be the favorite among the investors if the India will be outperforming other global markets. So that's all for now. Like I think like I have discussed a lot of things here. Might you might be forgetting or might not be have understood few things. So this article is there on my website on Dalal Sea Investor. So anyone who want to check about more about this, about the ABCD or how to evaluate mutual fund, can go through this article. And if there's are some questions, you can just drop the questions on this on 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 the comment section, or can ping me on my Telegram ID, Jalaj IITR, and I'll be happy to help you. Okay, thank you for now.